Welcome to the Fund Your Retirement podcast.
Yeah, a good advisor would kind of do this thing naturally, but when you realize that how many different things and distractions there are, it's enormous. And I think it will, and it particularly, we talk about retirement. If you think about the point where you're thinking, right, I'm going to stop working, you've got no necessarily income coming, you've got a finite amount of resources, you are much more sensitive potentially to what's going on. So your likelihood of wanting to secure and maybe reduce risk or to come out of the market at the wrong time is heightened. And you have to be quite strong and confident to just sit back and go, this feels unbelievably uncomfortable, but I know the right thing to do is nothing. And that's what I say, a good financial advisor will really help you through that process.
Welcome to the Fund Your Retirement podcast. I'm Lee Cleesby, the co-founder of Fund Your Retirement, welcoming you back to your weekly insights from our expert guests in finance, business, and wealth building strategies, helping you fund your retirement. I'm very pleased to introduce Anthony Villis, Managing Director of First Wealth, a financial planning firm and a certified B Corporation. Anthony is a chartered financial planner, a certified wealth manager, and a qualified financial coach and mentor. As Benjamin Franklin once said, if you fail to plan, you are planning to fail. Hello, Anthony, and thank you for joining us today. I really appreciate you coming on.
No, it's good to be here, Lee. Thanks for the invite.
Yeah, no, fantastic. And thank you for coming on and sharing your insights on financial planning. And, of course, we're going to be discussing evidence-based investing and using tax-efficient ways that people can save for their retirement. But what I like to do, first of all, is just like the guests to share a little bit about their background, their journey, how they got started for you, how you got started in financial planning, all the way through to managing director of First Wealth. That'd be fantastic if you could share that little story.
Yeah,
please.
No problem. I'll make it short. So I was at Bath University and I sort of graduated, did my economics degree, and then I just basically wrote to loads of companies in the yellow pages looking for a job. I wanted to stay in Bath because I loved it there.
Yeah.
Wrote to accountants and financial advisors. I got a couple of interviews. Got an interview with Chase DeVere, and they said, go and do some exams and come back, which I did, and then got a job there when I was 21. Loved it there. Brilliant, amazing 10 years of my life learning from some super people. They got sold to the Bank of Ireland. I went traveling for 2 years around the world, came back. I had a mate that wanted me to work and set up a financial planning practice in their accountancy business, which I did. And then financial crisis happened in 2008. And we thought we can probably do this better ourselves. So we set up First Wealth in 2009, and that was whatever that is now, 13 years ago. So that's where, and then we built the business from there. So that's a very quick history of where we've been.
Brilliant, yeah. And you just won a recent award. Was it in 2021 for? Yes,
we won Chartered Financial Planning Firm of the Year. So that was our sort of probably the biggest accolade in financial planning for a company. So yeah, we were over the moon to win that. We've been trying for a few years. We got into the last three times, and we didn't win. So this was the first time we got across the line. So yeah, we were delighted to win that award.
Yeah, brilliant, fantastic. And you're certified B Corp as well, aren't you? Which is really great. It's a good achievement as well.
Yeah, so we became a certified B Corp very much around wanting to be a business for good. So rather than just being, hopefully a great financial planning firm, but what's our impact on the world? So how do we look after our clients? How do we look after our team? What our impact is on the sort of environment? And then what's our impact on the community we're in? And then how do we govern ourselves? So it's been a fantastic, almost like a framework to improve our business and to sort of get better in different ways rather than just maybe just the client part in itself. So it's been, it's been great to be part of the B Corp community.
Yeah, well, probably when you're looking at every aspect of the business and making sure that what you're doing is for good, that probably permeates through the whole ethos of when you're dealing with clients as well. It's all about how can we benefit the planet, the environment, and the client.
Yeah, exactly. I think we very much focused on around sort of financial well-being. So how do you help clients to achieve purpose and what they want to be doing, living with purpose and having fun and enjoying their life? So rather than let's make money for the sake of it, what are the things that you value? What are the causes that you support? How do you want to spend your time? And then helping people to live that life with well-being. And then it obviously extends through to how we look after the team, and then of course, it's around how do we look after the environment. And so we've got a financial education brand that we're building called Let's Talk About Money, that people can find on Instagram, and we want to get that more into educationary courses as well to help more people rather than just our first world clients. So there's a lot of stuff that's going on, and we're pretty motivated to try to serve the financial planning profession and move things forward rather than obviously looking after our own clients, but having a wider impact and making things better for everyone. Hopefully, that's the plan anyway.
Brilliant, I like it. So, plenty of studies around show that only 1 in 10 of UK residents actually seek out financial planning or regulated financial advice. So, could you explain to the audience, like, what is a financial plan and why is that important? Why should people actually seek out, the services of a financial planner? And
I think the key with a financial plan is to have a clear objective of where you're trying to get to and what are the things that motivate you, and what are the things any gaps that you have in it. So, right, what are your objectives? What are the things that matter? And then building effectively a strategy to get to where you need to be. So it will encompass all sorts of things around, having a sort of a backup, a safety net, things like if things go wrong from an ill health perspective, or, life cover, all those things insured away. But then around how much you need to save, what your strategy is for the future. And then a lot of good financial planning is around coaching as well. So helping people stay on the journey. So we're all prone to make bad financial decisions. That's just unfortunately who we are. It's a part of the whole sort of fear or flight sort of mentality. So how do you as an advisor keep clients on track? And a lot of it's hand holding at the right times of stock market volatility or news that come out. Just stay the course, keep invested, make sure you're not distracted from things, and then that's how to win. So it's sort of slow and steady sort of wealth accumulation, and I think that's where a good financial planner can really help you.
Yeah. So would you say that your busiest time is perhaps when the markets are volatile and there's a lot of talk about market crashes?
I think it is. I mean, I think, we probably would say you add more value as a financial advisor during a market volatility than any other time. I mean, because you potentially have an impact that can save clients hundreds of thousands of pounds. I mean, not just maybe at that immediate moment. For some clients, it is that sort of immediate moment, but the compounding of keeping investing and then recovering is vast. So, you go back to 2020 March when COVID, the big sell-off. I mean, the market sell-off in that stage was very, very quick. So, you've been proactive with the clients, phoning all the clients, talking them through it. Some of them, been around, seen it before, much more relaxed about it, maybe been through the financial crisis, but maybe some new investors or people who are worried about it, reassuring them that we've been here before. I know it feels uncomfortable, but this is all the data that goes behind staying invested. And of course, the people that did stay invested, which were 99.5% of our clients, saw then a very quick recovery of their assets, and back to sort of all-time highs, not long ago, which the stock market almost, particularly America, almost has doubled from that trough to the peak. So if you've been out of that market at the wrong time, so it's hugely important that people are able to stay invested, and if that's something that good financial advisors should be really helping you with over time.
Yeah, I suppose what you're sharing there is your experience in the industry of seeing these every 7 to 10 years we have a correction, we have a recession, and as you've been there, seeing that, you can share that experience with the clients and as you say, coach them through it. It's
a lot of it's around empathy and understanding, and it's sort of that being been around for a bit, seen it before, and we know the data, but it feels uncomfortable, right? So we know that it does feel like if you've invested and your portfolio has dropped by 20 or 30%, that feels uncomfortable. And particularly if you're coming up to retirement, you're thinking about the future. So it is easy to panic and do the wrong thing, but that decision to panic invariably costs you a small fortune in terms of returns because you're out of the market as it starts to recover. So it's a classic sort of loss aversion, very much one of the major sort of behavioral biases that we need to understand. And every client has it. Financial advisors have it as well. So, as an advisor, you need to educate yourself about the biases that we have as advisors, and then be able to then talk to the client, say, look, we're all in the same boat here, but we can try to help you by learning through what we've learned about these sort of biases and taking it forward. So, it's probably the coaching, I'd say, is probably the most important part of everything we do.
That's really interesting that the actual coaching of the client through the journey, is such an important topic of it. Yeah. And it's probably something that I'm not sure most realize that is such a big aspect of it. So yeah, good
No,
insight.
I think it's true. I think it's definitely become more sort of into the sort of the mainstream in the last few years. But I guess I think a good advisor would kind of do this thing naturally. But when you realize that how many different things and distractions there are, it's enormous. And I think it will, and it particularly, we talk about retirement. If you think about the point where you're thinking, right, I'm going to stop working, you've got no necessarily income coming, you've got a finite amount of resources, you are much more sensitive potentially to what's going on. So your likelihood of wanting to secure and maybe reduce risk or to come out of the market at the wrong time is heightened. And you have to be quite strong and confident to just sit back and go, this feels unbelievably uncomfortable, but I know the right thing to do is nothing. And that's what I say, a good financial advisor will really help you through that process.
Brilliant. So when you're actually helping them transition through retirement, essentially what you're doing is you're coaching them through that period. And as you say, their senses to what's going on in the world is significantly heightened because everything they've worked for that 30, 40, 50 years, that's their nest egg, isn't it? They don't want to lose it.
No, and this is the thing, and this is where it becomes so important. So, we'll talk about myths, but this whole idea of right, I've stopped working, I've got a finite amount of money, I need to protect it, I need to reduce risk. I'm comfortable spending money because I feel that I haven't got enough. All those things are going on. So it's then to be able to say, right, to a client, we've built a model. We know that this is what things look like. Get them confident, almost sort of coach them. This is what's going to happen on this journey. Let's not take less risk. Let's probably take as much risk or maybe more risk because you're going to live for another 20 or 30 years. So you need to have equity investments here that's going to give you the return to beat inflation. Yeah. But also not just that, but also the confidence then to actually spend money because an equity portfolio will go up in value over the longer term. So therefore the ability to take money out and spend it, because I think people, they stop and they feel uncomfortable spending their money because they feel like it's a finite amount. So it's that trade-off as well, saying, get in the right assets to give you the growth, be comfortable with what's going to happen with the market. The advisor should be talking to you about this is what's happened over the last 10 or 20 years. So you don't want to talk to a client about a drawdown when it's happening. You need to have talked to them about it before. This portfolio could drop by 20 or 30%, and it happened in 2020, it happened in 2008. This is what we would expect to happen. So when it then does happen, you're not on the back foot. Your clients go, right, we talked about this. I still feel it's uncomfortable, but we've had this conversation, and therefore I've sort of had some instinct that this potentially could happen.
Yeah, it makes sense. You're preparing them for the worst case scenarios, or hopefully that's only the worst case scenario, 30% sort of drop.
Yeah, absolutely. I mean, it's obviously go back to 2007, 8, probably markets, if you're fully invested equities, probably more like 40 or 50%. Probably the same sort of 40% potentially if you invested fully in equities during the COVID drop, and that was the speed of it. So these events happen, that's what happens. On average, the market drops by 40 or 50% once every 10 years. And on average, every year it drops by 15%. So it's just part of the part of the course. To expect it. You don't know when to expect it. That's the thing. But when it happens, it shouldn't be a surprise. It should be, this is just part of the investment journey.
So what I'm listening to you here, from what the original question was, why is a financial plan important? You're actually there with them the whole time. I'm listening to the way you're describing this, right from the day they join you to transition through retirement and into retirement. They're helping them, guiding them, coaching them, and almost like they're exactly what it is, a financial partner. So
exactly right. I think that's the whole point, really. It's it's so much more to it. The plan is and this is where probably the profession has evolved so much. So financial planner traditionally was like, buy a product, right? Here's a bond, or here's an ISA, or
kind of it. Yeah, that's what that's what it has, doesn't it? It has that kind of.
Yeah, so we talk about three things that we do. We talk about the financial plan. So what have you got? What do you plan to spend your money on? How are we going to fund it, right? That's what the plan is, right? So then we build a cash flow model, put that in front of a client, and then you stress test it. So we use something called Monte Carlo simulation, which is basically, right, the market, all different types of returns coming in at different times. What would this look like if we went for a 2008 or another COVID drawdown? Yeah. Show that to the client, go, look, we stress tested this and it looks good, right? So it's really about creating confidence, the financial plan. The second bit then is around the wealth management bit. So it's about evidence-based investing, which we'll talk about later on. But let's not pay too much to active managers because they underperform the market. Let's just get the portfolio to be aligned with an index, FTSE 100, S&P 500. That's all the data tells us that's the best way to invest money. Yeah. And then the third one we talked about is the coaching. It's the coach the client at the start. This is what's going to happen on the journey. We don't know when. When it happens, coach them through it. Go, look, we talked about this. This is what feels uncomfortable. And then we recover. And then it's the ongoing, just hand-holding as and when. Some clients will need more than others, and just keeping people on track. It's just about creating confidence and almost giving people the ability to feel good when they are spending their retirement savings, going, look, if this is invested properly and we don't do anything crazy like sell at the wrong time, you're going to be okay. Yeah. So you've worked for 40 years, 30 years. Let's make sure you spend the money you've retired and worked hard for to give you the best life that you can post-work.
Yeah, no, fantastic. So absolutely brilliant. I mean, we covered the plan there. It's excellent. So let's talk about what sort of the best ways that people can save. Like, so, people are out there now, they're kind of listening and thinking, right, well, I need to start saving first before I can even approach a financial planner. What are the best sort of strategies that they can use that leverage the tax efficient solutions that are already available for them?
Yeah, I mean, obviously the pensions is a major sort of standing block of any retirement plan. So, if you're lucky enough to have a work-based pension, then contribute as much as you can. Your employer will be paying into that. And if you can make overpayments, then definitely do that. Maybe some salary sacrifice, get as much into the pension as you can. Be aware of, the annual allowance and lifetime allowances, which, if you're lucky enough to get towards £1 million plus, that's a lovely position to be in. And not everyone is lucky enough to get to that stage, but pensions generally, because of the tax relief going in, is a fantastic way to save money. Yeah. ISAs are things, individual savings accounts, very flexible. So you don't get the tax relief going in, but you get tax-free growth on it. So you can build up a fund that's more flexible in terms of access. So that gives you the pension. You can't really access it until you get to retirement age. Yeah. Whereas the ISA, you can sort of access it anytime you like. So it's sort of quite a flexible way of doing it. So, I mean, those two are probably the main, almost the sort of the building blocks for any decent financial plan. I mean, there are a whole range of sort of investments and products, getting more and more sophisticated with things like venture capital trusts, enterprise investment schemes, which I would say once you've done your pension, once you've done your ISA, then you're into looking at other things for higher risk investors, really, because they tend to be more speculative. So it depends on the client's sort of attitude to risk, really.
Yeah. So there's actually a hierarchy. First, get your pension sorted, maximize your ISAs, and then start to engage on more sophisticated. Don't jump straight to the sophisticated.
Yeah, generally not. No, I think just, I think we're very much trying to sort of like vanilla works, right? So I think the point with this is that, our whole mantra is steady accumulation of wealth. So it's great to have higher risk investments that can perform very well, but they do carry a much higher level of risk. So get the basics in place, get your, from the right, get your emergency fund in place is the first thing to make sure that you've got a rainy day fund. Then look at pensions, then look at ISAs, and then look at more tax, things like some of the tax products, VCTs, CIS, general investment accounts. There's loads of other things you can do, but I don't think you need to get too clever with this stuff immediately. Just keep it simple and just keep regular saving. Keep discipline, keep putting the money away if you can. And that combination of the sort of compound return over time will really work for you.
Yeah, fantastic. Good advice. Yeah, brilliant. And on the call earlier as well, we discussed, evidence-based investing, which is one of the strategies that you use at First Wealth. I wonder if you'd like to share a little bit about what is evidence-based investing and how you utilize that as part of your strategy.
Yeah, so, I mean, I'm going to massively simplify things here, but it's probably the right way to do this. So
keep it simple.
Yeah, they're right. So there are two types of thought around investing. All right. So the one is pay a manager to do it. So what you would do is you would go to a fund manager, a big something like Fidelity or, Jupiter or Invesco or Henderson's or whatever, these big companies that everyone knows. And you give them the money, and the fund manager manages that money, and they make calls on the stock market. So they will think, well, I think this company is going to outperform this company, and they will buy a portfolio and trade it according to their views. The alternative is to say, well, I don't believe in active management. I'm going to just buy an index. So I will put my money into a tracker. Eventually, it tracks the FTSE 100 or the S&P 500, or a combination of global indices. Is what you can do. So they're the two schools of thought. Now, the reality is, and the reason we call it evidence-based, is if you look at data, then the large majority of active fund managers underperform the index. So if you look at data in America, over a 15-year period, 5% of active managers will outperform the index. All right, so 95% of fund managers underperform. So what you end up getting with is a portfolio that is effectively more costly, because you're paying someone to run it, that's going to underperform the index. So you're paying for underperformance, which is kind of exactly what you don't want to be doing. So if you, and that, on shorter periods, over a sort of 1 year period, it might be something like 60%, 40% under, or 60% underperform. And then as you go to 3 years, 75%. So the longer that investment period is, the less likely it is the fund manager will outperform the index. All right. So most of the clients we work with are long term. So for us as financial advisors, it's very, very easy to conversation. Do you want to be in the 95% of funds that outperform and pay less? Or do you want to take a risk of being in the 5% and pay more for that 5% chance? And most clients most clients wouldn't even say, right, we know the answer to that one, Anthony. That's a fairly easy one. So, and also by reducing costs, and then obviously that money is then available in your retirement pot, your savings pot, your ISAs, your pensions, whatever it is, it's your money rather than going off to a fund manager. So you're getting compound returns on the fees you're not paying, if that kind of makes sense. So that adds up over time. So we basically moved all of our clients to evidence-based approach as our sort of core holding. That's the main thing we would do for people's pensions and ISAs and things. We say we will do some peripheral tax planning around some of the sort of slightly more sophisticated products we have for, maybe some of our sort of entrepreneur, business owner clients. But the majority of the money is in evidence-based. So to put a thing on LinkedIn the other day, my pension is in my clients, same as the Clever's evidence-based approach to clients. My daughter's junior ISA is in the same. Our company investments are in the evidence approach. So that's what we do as financial advisors, because if you look at the evidence, well, you have to do that. And it also, the numbers are so compelling that it just makes absolutely no sense to do anything else.
And I guess as you as a financial planner and a financial coach then can share all that information with your clients and, help them understand why this reasoning has come. You've made the decision from that kind of evidence.
I mean, there's again, I'll plug, if you go on to, hopefully I'm allowed to plug this, but if you go onto the First Wealth website, and there is a resources page on there. So if anyone's interested in finding out more, there is an evidence-based investment guide that you can download. I think you put in your email address, and then we'll send you a copy for free. And you'll give you the breakdown of what it is, why it works, and some of the data that backs that decision as well. So it's a really useful resource.
I'll make sure the links are in the show notes for this. So if anyone's listening or watching, go in the show notes. There's the link, and you'll be able to go straight to it. And that's a fantastic share. Thank you. So that for me, there's loads of great insights in that. As we come to the end of the interview, what are some of the myths you'd like to bust around financial planning and regulated advisors? What are some of the myths that you'd like to say? Look, we've moved on, or things are the way they are today.
I think the world is changing. Again, I started my career 25 years ago, and I think then it was very much about sales and someone turning up to sort of wants to open the coat and like, what watch do you want to buy, what endowment do you want to buy. It was like, what have you got for sale? And I think that's changed so much now. There are so many fantastic financial planners in this country. So make sure you find someone who's got a decent reputation, someone who's chartered potentially, and you will get good advice. So that's one thing. That sort of myth of the old salesperson, I think, is changed quickly. But we're talking particularly about retirement. There were lots of myths around risk. This thing we talked about earlier on.
That's a good point.
getting towards retirement, and you must reduce your risk. And that's the sort of thing that was based on the fact that go back years ago, that when you got to retirement, you bought an annuity. So the idea that you have a fixed retirement date and therefore you convert everything you've got into a fixed annuity for the rest of your life, that doesn't exist anymore. You have so much more flexibility. So the point is, if you're going to be living hopefully for 20 or 30 years post-retirement, and your life expectancy would say that's the case, then you need to be in growth assets that are going to inflate over inflation. I mean, you've got inflation running at 5% at the minute. If you're invested in cash and bonds, your real return is going backwards. And if you compound that up over 20 or 30 years, your standard of living is going to have a dramatic fall off. So the only way to combat that is to be invested in a portfolio of equities that will outperform inflation. Now, it will be more volatile. So one of the biggest myths is, right, I need to de-risk my portfolio at the point of retirement. If you are going to buy an annuity, then that's still the case. But more and more people are going into things like drawdown now, where actually you need to be invested in equities. So that's one big thing. And I think, therefore, the other thing that sort of follows on for is this whole thing about lifestyle funds. So a lifestyle fund is essentially something that you're in a fund that kind of naturally de-risks itself as you get towards retirement, maybe 3 to 5 years. So they start putting more and more in bonds. So you're reducing risk, reducing your growth potential. But then if you're not going to buy an annuity, you then need to be getting back into the market. So you're kind of de-risking yourself at the wrong time to then go back into stocks. So for a lot of clients, you need to be very careful around lifestyle funds. They're not to say that they are inappropriate for everyone, but for I think there's a lot of people invested in lifestyle funds where it is exactly the wrong thing to be in. So you need to this is why you need to have a plan, because the idea is, with the plan, you've done your cash flow. Is an annuity right for you, or is a combination of an annuity and a drawdown right? Okay, right, that's what it looks like 5 or 6 years ago. Therefore, that will then dictate what investments you're in, because I think actually I'm going to be in drawdown, or that bit could be a bit of an annuity. There are different ways of doing it. So we look at particularly around expenditure. 2 types of expenditure very broadly. Basic expenditure is your food, your bills. If you're lucky enough to be able to cover your basic expenditure through a fixed income, state pension, and annuity combination, then you know that whatever happens, you're going to be okay. If you've got additional funds, then that you can take a bit more risk with, there may be in drawdown, holiday funds, longer term plans, that funds, education funds, whatever, for kids, grandkids, then you can pull different outcomes. So it doesn't need to be one solution for everything. So there are lots of different ways to do this, but it all starts with the financial plan, how much risk you want to take, a conversation about the benefits of equity investing and the volatility. So it all sort of fits together.
No, it makes absolute sense. And I'm presuming the problem with the annuities is when people come, the myth around annuities is when people come to retire, if the stock market was in a 30% drawdown, then your annuity wasn't going to be worth as much as it was if it was at all-time highs, is it? So
correct. Well, that's the point, and that's why that's why these de-risking strategies used to work. Because you're right. If you say, let's say, £100,000, and that would have given you a £4,000 a year annuity. If that £100,000 dropped to 70,000 the day before you retire, then all of a sudden you've got 4% of 70,000. You're going to be 30% worse off in terms for the rest of your life, because you've locked that in. Whereas if you're taking a drawdown, if the market drops by 30%, it kind of doesn't matter, because it will recover. So as long as you're not needing to buy an annuity, then it actually doesn't, the volatility doesn't matter at all. And I think one of the biggest things that people maybe confuse is the difference between loss and volatility. So you only lose money when you sell at the wrong time. So if I've got £100,000 portfolio and it goes to 70 and I sell it, I've lost £30,000. If I've got a £100,000 portfolio that goes to 70 and I do nothing, you've got volatility. It's gone down in value, but you haven't lost anything because it will come back. And I think that's a big thing around what is risk. Risk is not volatility. Risk is selling and making inappropriate actions at the wrong time. And I think that comes back to the original point, why having an advisor can
I was just going to say,
to deal with that is just so critical. And I say a lot of people listening to this will know this anyway and feel comfortable that they can handle that volatility, but everyone is very different. So if you are uncomfortable with volatility, then probably it is a good chance to speak to an advisor and make sure that they're on the same page when it comes to this sort of ongoing coaching.
Yeah, no, brilliant. So, and where can they get in touch with you, Anthony? Where could they get in contact with you and, book an appointment or learn more about First Wealth?
Yeah, I mean, if you go to our website, then there's opportunities there to book like a 30-minute. We do 30-minute video consultations for anyone who wants to talk about how potentially we can help people with their financial planning. If anyone's on LinkedIn and they want to send me a message, just tag me on LinkedIn and send me a message if you want to find out more as well. So they're probably the two best ways to make contact.
Yeah, and like I said earlier, I'll make sure the links are in the show notes. So anyone listening or watching, go in the show notes and get yourself an appointment booked. Thank you.
Lovely. Brilliant. Thank you, Lee. Pleasure. Thank you.
Take care. Bye.
Cheers.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and our website, fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.